I want to talk about what short selling is. Now, short selling is something that's typically employed by hedge funds to make money to benefit from the value of a security dropping. Now, typically we think of making money when something rises in value. We buy something cheaply and we end up selling it for a higher price, and that's how we make money. But obviously a great thing would be if we could figure out a way of making money if things decline in value. So we could make money in rising market environments or rising price environments or declining price environments. And the way this is done is through short selling and for hedge funds, and it typically, let's assume it involves a stock, and it can involve other securities as well, as long as they can be borrowed and bought and sold, and we'll go into that right now. If we think that a stock is going to drop, and let's say the value of the price of the stock today is $10, what we could do as a hedge fund through an intermediary is borrow that stock from somebody that owns it. And somebody that owns it could be a mutual fund that has to own it because of its benchmark. It could be a major institution that has a different belief than we do, and therefore they want to hold it. But the bottom line is we could, through an intermediary, typically a bank, we could borrow that stock and then sell it. So let's say the stock is trading at $10 and we borrow it. We could borrow it and sell it in the market for $10. Assuming it drops in price to $5, we would then buy it back and return it to its original owner. And we would have made $5 effectively, less any costs for borrowing the stock. So we would have benefited by selling the stock first at a higher price, a stock that we didn't really own, and buying it back at a lower price and returning it to the original owner. We would have benefited from the price decline. For the person or the institution that we borrowed the stock from, what's the benefit? Well, first of all, they would have held it anyway, either because they needed to or because they wanted to. So, and because they thought it was going to rise, or because they had wanted to hold it because of their benchmark. And they're guaranteed at least a return for lending out the stock. So they're typically paid by the person that short sells, by the institution that short sells the stock for lending out the stock. So they make a return for lending it. Now, let's say we're the hedge fund, we borrow a stock at $10 and we sell it in the market and the stock rises. Well then, let's say we buy it back at $15. Basically we would have lost $5 and we would have had to pay for the borrowing costs. The original owner that held it would get the borrowing costs, and obviously their reasons for holding the stock would have been validated, assuming that they held it because they thought the stock would go up, and they would get the return of the stock having gone up. The point is that the short selling allows one to sell a stock that the institution doesn't own and to potentially benefit from price declines. And it also obviously means that if the price rises, the institution would lose money. Short selling is also done in the context of hedging a risk, for example. So what we could do is we could go buy a certain security and then short sell another security against it. So net, our risk would be mitigated because we would own one thing and we would have sold another thing. So net, we would have mitigated our exposure. So for example, we can buy a certain number of stocks and short sell another certain number of stocks. And on an aggregate basis, we would have reduced the risk of having just owning those stocks, because we would also benefit if the other stocks decline. So our market risk could be mitigated, and we can hedge out lots of different risks in that way. For example, we could buy a US security and against that short sell the dollar and benefit, the US dollar, and benefit from a price decline in the dollar. So even though the price of the security we would lose if the dollar went down because the security is denominated in US dollars, we would benefit by having sold short the dollar and would therefore benefit from the price decline of the dollar. Bottom line is, short selling involves borrowing securities or assets, selling them in the market with a view that they'll decline in price, buying them back, and benefiting if the price has declined, losing money if the price has risen, and in either case returning the investment, the security, then back to its original owner from whom it was borrowed. That's what short selling involves, typically done by hedge funds.